Hi, Michael Zahrt here to talk to you about tax planning for farm losses. We're in the middle of a wet harvest season, and it's doing no favors to our farmers who have already endured a wetter than average planting season. And what all this means is that we have a lot of farmers who are probably going to be taking a tax loss this year. Now, prior to 2018, tax losses were kind of a silver lining to a bad crop year, right? Because you could carry them back, carry them forward, and you essentially got a dollar for adjustment. So if you had a really good year, you can take your really bad year and it all comes out in the wash, and that was fine. At the start of 2018, that's no longer the case. They've changed the way those net operating loss rules operate, and losses aren't what they used to be. And we'll get into that a little more today. Now, the old loss rules, you could carry a loss back 5 years, you could carry it forward 20. Under the new rules, you can only carry it back 2, and you get to carry it forward indefinitely. That's just kind of tweaks, what's the harm? The harm here is how you get to use it. It used to be you could take a loss dollar for dollar against taxable income. Now that's not the case. You can only offset up to 80% of taxable income with a carry forward or carry back loss. So for example, if you had taxable income of $100,000 last year and you have a loss of $100,000 this year, under the old rules, you would just amend that old return and it would be a net zero and come out in the wash. Under the new rules, that's not the case. If you try to carry that back, you can only offset up to $80,000, 80% of that $100,000 taxable income. There's no way to get out of that extra $20,000. Same thing for carry forward. So that's one instance of where we've changed the tax code a little bit and it's not great for farmers. The second is applicable for big losses. There's a brand new tax provision out there called the excess business loss rule that essentially functions to cap your losses at $500,000 per year. So if I have a loss of $600,000 this year and I have $1 million in taxable income next year, under the net operating loss rules, you might think, well, okay, 80% of that is $800,000. I have a $600,000 loss. I can use the whole thing. Not so fast. Under the excess business loss rule, you only get to use $500,000 of that $600,000 to offset that income, and you have to carry the remaining $100,000 over into the next year. So not only are regular losses now what they used to be, the big losses, you're stuck with only $500,000. So the paradigm has changed a little bit here. Instead of saying, I'm having a bad year, let's ramp up this loss and really take advantage of it in previous years or future years, your goal now should be, let's try to get taxable income as close to zero as possible. That might be easier said than done this year, but we've got a few tips that might be helpful for you. The first is capitalizing expenses. You might buy all your fertilizer, pay for it, take the expense all in this year. One thing you can consider is capitalizing that, stretching that expense for tax purposes over a span of years. Now you're not taking such a big loss, you're bumping it up a little. The same thing goes for bonus depreciation. Under the old rules, you'd almost always take bonus depreciation and take a current year deduction for 50% of whatever you've bought this year. That might still be the case for some long life assets. If you buy land that's 30-year property, go ahead and take the bonus depreciation because you're still going to be able to stretch that out quite a bit. But that 5 or 7 year equipment that you bought, instead of expensing all that in this year, consider taking 20% at a time. Consider stretching that over the 5 to 7% period because you're not generating as big of a loss. The third thing you can do if you sell grain is consider your deferred contracts. If you've got $200,000 worth of grain to sell to the elevator, don't do it in $200,000 contracts. Do it in 20 $10,000 contracts. Because those deferred contracts essentially let you choose which tax year you want it in, right? You can pull it into this year or you can wait until next year to figure out where you want your income. So if I'm sitting on a $50,000 loss and I've already pulled in one of my deferred $100,000 contracts, you're stuck in a situation where you say, well, I got one more $100,000 contract here. Do I want to pull it into this year and have $50,000 of taxable gain? Or do I want to leave it until next year and sit on my $50,000 loss that I know isn't as good as it used to be? Whereas if you take a whole bunch of those deferred payment contracts that are $10,000 a piece, well, maybe now you pull in 5 and you hit exactly zero where you want to be. You don't have the loss that's not as good as it used to be, but you don't have the huge taxable gain this year either. So that's the third thing for you to consider. Now there are other small tweaks and changes you can do, and you should discuss this with your CPA, and you should also contact your Foster Swift tax attorney to determine what is exactly right for your farm this farm year.